Hello. Good evening, everyone. Good afternoon, everyone, and good morning to those who it might be your morning. Welcome to episode 10 of the Hidden Edge Pod. It's been quite some time since we had an episode with our busy lives, but there is a lot to talk about. So what we're going to start talking about first is macro and unemployment. Kind of go over a little bit what happened last Friday. The infamous Trump and Harris debate that everyone was watching recently. We're going to talk about that. We're going to talk about the great NVIDIA pivot. And if you don't know, then it'll be news to you. Some real estate nightmares, loading up on cybersecurity, and then the Apple AI iPhone 16 that's coming out. So straight to the top.
Harris debate. We got to do that. Let's get that.
We're doing Harris debate. Okay, we'll do the Harris debate first. All right, let's go. The Trump and Harris debate.
First of all, it wasn't a debate. It was a gangbang. Okay,
it was a gangbang. It was.
It was 3-on-1.
Yeah.
Trump. But the thing is, like, I feel bad because Trump should have been able to kind of deflect and get a lot of the stuff off, but we wasn't able to. So, I mean, at this point, I think we spoke about it before. I don't think it really matters who the president is. At the end of the day, it's just you're pretty much going to get the same person either way. All the policies that Trump could have created, they would have been good for the economy. The ones that Harris creates are good for the economy because, this is the dirty secret in politics. Politicians don't actually write the laws. Like, see, some people think that there's actually, like, when you elect somebody to be part of the House or the Senate or whatever, you're sending them to Congress, and Congress, they're sitting there writing the laws themselves. It's not really the case. Most of the time, the law is written by the lobbyists, and basically the lobbyists kind of just like go back and forth. So it's like their lobbyists versus our lobbyists, and they essentially write the laws and they make the modifications to get as many people on each side. And a lot of times what happens is even when they go to like the vote, it's all pre-negotiated, like who's going to actually vote for what. And that's why a lot of people think Nancy Pelosi does insider trading. I don't think she does insider trading. I think it's way more nefarious than that. You know what that is? That's insider law creation. So basically what happens is you create laws that benefit certain people and certain parties, that may be third-party actors. So I'll give you an example. While we're all talking about all this debate bullshit right here, like, oh my God, who gives a shit? Like Trump said this and Harris said that, and women have dicks now and men have pussies. Like, all that stuff is completely irrelevant to actually the real policy decisions that actually impact us. Lussies, whatever you want to call it. But one of the things that happened today, but no one even like cares, is this right here. Let me just share my screen.
Go for it.
This right here. The Fed, it actually backpedaled on some of the capital requirements for banks, right? So because of everything that happened with SVB, banks were supposed to basically increase the level of capital that they hold on their balance sheets so that this way it prevents any future risk. Well, turns out the Fed said, you know what? Maybe y'all don't need to hold on to so much money in your bank accounts. Now, lend it out. Go ahead. Now, what does this mean for the banks? That means the banks become more profitable. The more money you can lend out, the less capital you keep on. But everyone is talking about the Trump-Harris thing, and it's like, no, this is the actual news story that people should have been following. And let me just listen to this real quick.
Supervision.
BTFP is gone.
Michael Barr is speaking right now, previewing a proposed package of revised rules for the country's biggest banks. Here with the latest, we've got our very own Jennifer Schonberger. Jennifer, great to see you. What do we know so far?
First of all, this is crazy to come out there and say, we're going to do this, we're going to do that from a regulatory standpoint. And then you get pushback from Wall Street. And now what happens? Now
that's crazy. From 20% to 9%. Holy shit.
Yeah.
That's insane.
Good morning, Brad. Great to see you as well. The Federal Reserve unveiling its planning sweeping changes to massively scale back a proposal to raise capital requirements for the nation's largest banks after politicians and banks had pushed back on an initial plan, warning that it could restrict lending and hurt the economy. The new proposal, known as Basel III, would increase capital levels For big banks like JP Morgan and Bank of America by 9%. That's down from half of the original plan from more than a year ago that set the capital increase at 20%. Now, banks with assets of between 100 and 250 billion, which were initially subject to the stricter standards of the largest banks, would no longer be subject, other than the requirement to recognize unrealized gains and losses of their securities and regulatory capital. This is a major reversal following a string of regional bank failures last year.
Okay, so first of all, why is this relevant to us? I want to ask you, why do you think this is relevant to us?
This is definitely relevant to us because that means that if the banks don't have to keep 20% capital on their balance sheets or whatever it is, then that means they can loan out an additional 11% of their capital out, which means that there's more liquidity in the system and people will be encouraged to spend more because banks will do whatever they can and not keep that on there. Like, would you rather have 11% of your funds earning whatever interest that the overnight repo is paying, or would you rather loan it out for about 6%? And when you're talking about like hundreds of billions of dollars, that actually does make a huge difference, even if it's like a fraction or a few basis points. Makes a mega difference, even if it's like overnight. Makes a huge difference. So then that's going to force more liquidity in the system. I was actually talking about this on a Spaces today regarding how they're tapering the quantitative tightening. And I actually forget that the way they're doing quantitative tightening, which is about $25 billion that the Fed is letting mature or roll off their balance sheets as far as treasury securities that do get matured. When they get into the point where they're going to do quantitative easing, that means that they are going into the market and they are purchasing treasury securities in the market, and they're taking treasury securities and they're putting money into the market, which is, I guess, technically that would be printing because they're basically increasing the debt in their balance sheet. But for the most part, this is kind of a similar situation they're doing without actually doing QE. They're forcing banks to push more liquidity into the system by loaning at a much higher rate. Good for banks. Now, why did JP Morgan drop so much today then? Would it have to do the Ally Bank situation or?
So let's dissect it into two different things. Number one is, let's talk about this and then we'll go to why the banks actually dropped a little bit today. I think the more important thing was the second part. I could care less about the large banks because there's not a lot of alpha in the big banks. More alpha is actually in the regional banks. See, the regional banks, if you look at some of the ones that we've been covering, like one of them is of course TFC, right? Truist. Prior to SVB going down, look at what Truist's stock price was. About in January, it was about 22 at about $60 a share, right? So post COVID, they literally did a huge turnaround and it went up. The problem is when the Fed started to raise interest rates, a lot of the assets that they had on their balance sheet were lower yielding debt. That lower yielding debt will slowly roll off. But the major problem was it causes something called AOCI losses. So it's basically paper losses where if you lent out money at 3% to somebody and now the Fed is giving you 5.5%, it looks like, oh my God, you have a paper loss of about a lot. It doesn't mean that the creditor is not paying you. It just means that you're not getting paid as much. Well, not as much, but you're basically on the books. It looks like you have an assets that's negative yielding, right? The thing is, now the Fed is likely to cut interest rates, right? And you've got TFC still trading at $41.92. Now, of course, we in the Patreon, we did a really good job. We bought a whole bunch of spreads between 27 at the time. I think we bought 30 and 45. So it's like almost a $15 spread. And it cost us like $2 and something for everyone that's holding. Congratulations.
Yeah, those things were cheap, dude. Those things were very cheap.
So now what you're going to see is a lot of these regional banks. One of the reasons why they went down so much is because of the whole thing with the AOCI losses. But now that, the Fed is going to cut rates, it's going to go in the opposite direction, where now on a tangible book value wise, you're actually going to be gaining like, what is that thing called? Like, at least on paper, you're going to be gaining equity. So that's a really good thing. The other thing is, a lot of the banking requirements, because of like the stricter lending requirements that the regional banks could have been put under, now they were basically now capped at how much more profitable they could be, because now they can't lend out as much money. The good thing is, with this rolling back, they don't have that cap anymore. And the only thing is, they have to recognize AOCI losses, but within the next couple of years, the AOCI losses are going to be next to nothing, which at this point means that their balance sheet and their equity balance goes up tremendously. So one of the things you'll see is regional banks doing really well over the next couple of years. They're going to be lending out more money and generating a ton of return. You know,
let me share my screen real quick. Just wanted to do some TA because I was actually looking at TFC today at the action that was happening, and I was like, hold on a second, we might have a good entry point over here. So if you look at TFC, the green is a 50-day moving average, the blue is a 100-day, and the red is the 200-day moving average. Actually, let me just verify that real quick. Yeah. Okay. So today we actually broke through the 50-day, which is, I guess, considered bearish. However, as long as the 50 is above the 100, I do consider that still a long-term trend up. Even though we've crossed down, I would probably wait here if I was going to get into TFC until we possibly test the 100-day, at least get close to it. But we have seen the last time that it jumped over the 50-day, it did come back to retest it, and then it made this massive move up. So we've had a pretty considerable move down since its recent high, since the SVB incident. But going back to talk a little bit more about fundamentals, can you just, I guess maybe there might be some people who are a little unsure about how this plays a significant role. I know you just explained it, but in like layman terms, to kind of go upon that, can you go back to SVB and explain what the buy the effing pivot, or the bank, I forgot what it's called, the BTFP. Can you explain to people what exactly that was and why that has, even though they ended that, why this is even more significant than what they had done in the past, and why this might actually be very bullish for regionals versus the large banks?
All right, so we have to go back to SVB and figure out why exactly SVB collapsed. And same thing with not just Silicon Valley Bank, but the other one, I forgot what it was called, First Republic. First Republic.
Signature Bank too.
Yeah. So all these banks, they cater to like really wealthy clients. And basically what they would do is they would lend out, you would put money with them, and then they would lend it out. And the thing is that they would have a white glove service for their lending, you know, and they would make money on the fees and all that stuff. But one of the things that they were doing essentially was they were also shilling for the rich, right? These companies that are in Silicon Valley, they have a tremendous amount of capital that gets deployed with them. Same thing with a lot of rich people. They get a lot of money. So a lot of people with First Republic, they weren't like your mom and pop, like me and you kind of like people. Okay. You're talking about people with net worths over $10 million, maybe even 50 million. So they would put all that money in the bank. But the thing is, the bank itself would lend you your own money back to you at a very, very preferential price. Now, why is that important for the people that are at the top that are rich? Well, number one, they love white glove service. So a lot of these First Republic people, they got wine, dined. Like if you needed a private jet from one place to another, they would do it on the bank's dime, basically. So the bank put all of those things as expenses. So you, as the rich person, you don't have to go out and spend your own money. One of the things you'll find about rich people are cheap as hell. Like real rich people, they are cheap. Okay. Fake rich people, they're all about the Louis and let me show you this.
Well, that doesn't mean that they're cheap. It just means that, well, the reason why they got that rich and stayed that rich is because they weren't blowing their money out. And like I said before, like they might not have hundreds of billions of dollars, but like 5% on like $100 million a year is you're basically getting $5 million a year like that. So that's a pretty big deal to them.
So I would say it's more like, look, I have $1 billion. I'll keep my $1 billion in your bank. You lend it out to other people, you make money on it. But in return, you give me a mortgage, right? On paper that says, you know, for X. And so a lot of like, this was a lot of back dealing that was happening. The problem is rich people are also a lot more risk averse. So when this whole thing with the banking thing came around, they pulled all their money all at once and basically left these guys with a negative thing. Because the thing is, when you lent them money, they didn't just go out and take that money and do stuff with it. They actually bought like things like treasury bonds, which are really, really secure, you know? So a lot of the stuff that they had was actually like pretty secure stuff. It's just from an AOCI last standpoint, it's bad because, banks can go insolvent because, like, let's say right now you lent them $1 billion, they take that $1 billion and they buy, like a 2-year treasury or a 10-year treasury that's yielding 1, 2, 3%. And then all of a sudden you come to the bank the next day and says, I want my $1 billion back.
Yeah.
Problem is that treasury bond could have halved because the current interest rate is 5% on a new treasury bond. So the value of that treasury bond that they have to sell it in the open market at a 50% discount. Now, all of a sudden, that giant gap between the money that belongs to your client versus how much you actually have goes down by 50%. Now you take basically a giant loss having to pay these guys back. So what happened was the Fed came in and said, look, we don't want any more of these regional banks collapsing. So what did they do? They basically set up a program where the Fed came in and my mom came from a rich family and penny pinched every cent of the day. Yeah, probably. So the Fed came in and said, look, instead of going out there and selling your treasuries at a discount, let us hold your treasuries on our balance sheet. We will give you the money. And eventually like when all of this bullshit ends, you can have your treasuries back and we'll get our money back. Right. So that's where the program came up, where basically all these illiquid assets the Fed took on and gave these guys money so that this way they could be liquid and basically be able to kind of pay their creditors. And so once the creditors backed off and said, okay, my money is safe, more people started putting money back into them. The thing is, this was open to all these regional banks. Otherwise, we would have had a giant crisis and we could have literally gone off the deep end with a lot of the regional banks. The one thing was, in order to basically get that carrot, the regional banks had to take a little bit of stick. So the stick that they had to take was higher capital requirements so that this wouldn't happen again in the future. And now all of a sudden, the Fed comes out and says, hey, listen, remember that rule that we created to make sure that you guys fucked up the first time? And so we backstopped you guys. Yeah, don't worry about that rule anymore. We got it covered. You good. And so now all of a sudden it's like, wait, what? Like the condition that you basically created to prevent this from happening in the future, you just rolled it back. And the thing is, people are really not understanding how big of a monumental shift this is because everyone is focused on, cats and dogs being eaten in fucking Springfield, Ohio and shit like that. It's like,
I guess we don't really need to talk about the debate that much, but we obviously know who dominated that debate. So anyways, going back to the bank thing, that's actually pretty interesting. I got to be completely honest. I didn't even know about that. I was more focused on what was happening with Ally Bank. And I was looking forward to the debate today. I'm just like, that was a waste of time. Like, I don't think anything really came out of the debate. Anyways, what we are seeing overnight, though, on the markets, let me actually share my screen.
Wait, let me just clarify the thing.
Yeah, go for it.
For Ally Bank, the reason why all the banks were down today is because Ally Bank came out and said that they're having a lot more delinquencies than before. So basically, Ally took a huge hit down, and so people are now worried about the banking system with regards to the outstanding loans.
So I didn't look into it that much, but I'm pretty sure you did. What kind of loans does Ally Bank have the most?
Auto.
There you go. Yeah,
they're one of the largest auto loan banks in the country, and the thing is, autos themselves have not been doing really well. Used cars are in the market, and used car prices are like literally just down. So one of the things that you'll see is that used cars are a good benchmark for inflation and disinflation and deflation. So more than likely, we are going to get hit by a lot of disinflation and possibly even deflation, quote unquote, a recession. And I think the 10-year is like screaming at us right now saying, pay attention to me because you guys are really not understanding how important this is. And I actually created one of the things I put on the Patreon was this specifically. Let me just share the screen real quick. Can you see this?
Yes.
Okay.
Just share part of it because this is a public podcast.
Yeah, I'll just share part of it. So basically, this right here You know what? Let me see if I can find the original file itself. Just give me 1 second. Man, whenever I create these things, it's I have like this thing where I just like store them and then I don't even look for them again because a lot of the stuff is not relevant after. Sorry. Shortcut, screenshots. Jesus, where did I put it?
While you're looking for that, I wanted to just talk about something.
Yeah, go for it.
Regarding somebody was asking, or Lucy Picker, the model of Europe, was asking, why is Buffett dumping BOA so hard? So I don't know. Whenever I see that stuff, okay, so Buffett doesn't just, he owns preferred shares of these companies. So maybe he had some type of agreement or whatever, or maybe he wants to allocate the capital somewhere else because maybe he doesn't see proper upside. It's just, it's so hard to translate his actions into what he could be seeing. And even then, that doesn't mean that he's right. He's just an investor. I don't think that he was front running whatever was happening today based on that. But I do think that, I mean, he's always had a cash position and has been building one for quite some time. So I'm not so sure if that has to do with what happened today. Okay, go ahead.
Okay, so you guys can see my screen okay, right?
Yeah.
Okay, so I only have one monitor, so it's hard to. So this right here is a chart of all three of the types of. Yeah, I know, right? I really do need to get some better software, but Paint works and it's quick.
Microsoft Paint.
Yeah, I actually draw all the arrows myself. So basically, these are the three types of corporate debt that are very relevant: AAA, double B, and triple B. So basically, AAA, you're absolutely safe. Like, there's no way you're going to lose any money. They're like the safest yielding bonds that you could actually buy. Then, of course, you've got the then you've got the triple Bs, which are investment grade, but they're a little bit less, it's a little bit more risky, but not like bad. So triple Bs are, companies that are profitable, they're doing well, they're generating a net income, so they can pay their debt pretty effectively. And then you've got the double Bs, which are like a little bit on the more riskier side, where in the short term they might be feeling some pain. Their business is in transition, but essentially they're not technically high grade bonds, so the chance of default is higher. Now, here's the funny thing: if you look at the federal funds rate, which is technically the most secure that you're going to get because it's overnight money that banks lend to each other, that's trading at 5.25%, which is what the Federal Reserve is currently set the benchmark rates at. AAA bonds right now are already below the federal funds rate, which is actually not that uncommon. It does happen from time to time, but it's pretty bad. When you have that means that kind of like the federal funds rate is a little too high, and that the market is forecasting in the future the price of the yield to go down substantially. Then, of course, you've got triple Bs. This is the one that should shock everyone, because triple Bs right now are actually yielding less than the federal funds rate, which it's technically, I've never seen it happen. The federal funds rate
take on more risks. I don't know why though.
It's bad. And here's the thing that's going to shock the shit out of everyone: the damn double Bs are close to the federal funds rate right now on an effective yield standpoint.
Well, they're trying to front run it, because when they think about it, the cuts already are happening, considering that the 10-year has dropped down to 3.6%. And then on top of that, the short-term yields have, they pretty much uninverted, so they're actually a little bit less than that, probably like 3.5 something percent. But they basically front ran that. So you have these investors and big money, they're kind of forced to buy more of the corporate bonds, because the fact that the yields don't yield as much as they used to, they need to look to get more risk to get a higher return. And you can't, unless you're a bank, you really can't get the federal funds rate, can you? I don't know how that part of the market works, but
no, you do. You could get it through the treasuries, remember? Because right now, short-term treasuries
they don't yield as much though. Oh, that's right.
Really,
Yeah,
they do.
right. You're right. You're right.
Short-term
I was thinking that.
treasuries.
I was thinking 2 year and beyond.
The
That's going
key
to
is
change soon, though.
the key is duration. So
Yeah.
right now, everyone needs to like if you want real serious alpha right now, you need to buy duration, which
Well,
means
that's
that right
what's
now,
happening.
right, and
That's
that's
what's
what people
happening
are.
as you speak. Yeah.
Yeah. So right now, people are buying that up. Now, here's the good thing: the rate at which these these securities are declining from a yield perspective, it means that in the future we're getting almost like a telegraph signal of how low the Federal Reserve is likely to go. So the Fed's target is about 2.5 percent on the federal funds rate. The thing is, we're probably going to get there faster than a lot of people are thinking. So right now, we're at a point where
We're going to
yes, the
find out in a
market is
couple
scared of a
weeks.
recession. We're worried about a recession, but more importantly, the bond market is absolutely screaming to basically lower interest rates. And I think it's going to happen. And what's going to happen is there are going to be a set of companies and asset classes that are going to benefit significantly from this move down. And it's already happening. One of the ones that we spoke about, which was Vornado's preferred shares on the Patreon. Let me just show right here. So if you look at Vornado, which is a REIT in New York City,
And you're not sharing your screen. Oh, no, you are. Okay.
Yeah. Basically, they're up about 33% this year. But if you look at what they are from before, they were almost at $67 a share. And then COVID hits, they took a giant hit. And then, they were okay. They have AAA assets, Class A assets in New York City. So they're fine. But then they got hit with higher interest rates. So the thing is, usually these are businesses that require a lot of capital up front. And then what happens is they rent out the properties that they have and they pay back the creditors slowly. And then whatever's left on top of it, they pay their investors as a dividend. So that's how a REIT works. They borrow money, they build a product, they rent it out, and you get the difference between how much it costs to borrow money and how much you get in rent. The thing is now, a lot of those buildings, because of COVID, their leasing rates dropped. And then interest rates went up, which meant that their business model at that point was broken. The good thing is leasing rates are coming back up and interest rates at the same time are going down. So it means the future, this thing is going to be worth way more than what it is today, right? So one of the things is like the equity is really good to be in, but what's actually very interesting was looking at their preferred shares. Their preferred shares have absolutely been skyrocketing the last month because they actually started to get back into like positive territory with regards to net income. So they went from 15 to now 1880, and this ride up is really good because now you're going to get a yield. So you're going to get 5.4% yield on a par value of 25. Right. So you're going to get like almost like a 7% yield on it. But what's more important is that you'll also get this going back to par, which is at least another 30% in capital appreciation. So, there's a lot of great companies that have a very similar thing going on. And if you guys want to learn, you join the Patreon, and this is where we talk about stuff. And me and Matt actually have this as part of our portfolio. We have a couple of other preferred REITs that are actually worth looking at also because they're trading way below par. And at the same time, they're really good yielding securities, and they have yields that are, and some of them aren't even callable until like 2029. So that means that they can't just come out and say, you know what, we're going to basically call this security back. And if they do call it back, you'll get a tremendous amount of capital appreciation. So right now is the time to lock all of this stuff in while the market is still not. The market's woken up. Of course, you can see Vornado went from 15 to fucking 18. So, but the thing is,
they're going to be buying up that stuff. For the
so I have
time being, they're going to be buying up that stuff.
So I have a list of these
ahead.
things that are I have a list of these things that I'll slowly reveal over the next few months.
Wait till let people get in. Wait till let people get in first. Wait till they buy it, and then let them know. I wanted to share this is the latest SEP, or the Summary of Economic Projections, that the Fed did release last March, and they are going to release another SEP in next Wednesday. Was it next Wednesday? The 18th, right? So they're going to release it next Wednesday. And it's actually pretty interesting because during that SEP, we're going to see this updated table. What this table is basically projecting is where the Fed sees all of these variables on the left side of the table. Let me zoom in here. It's basically where they see all of these variables heading toward in 2024, 2025, and 2026. So this is like the end of the year, and then the longer run. What they do see is that GDP is going to basically remain constant around 2%, and then the longer run go down to 1.8%. And they do project that unemployment is going to. This is the thing that people are kind of like inferring, because remember, this is from June, right? So I did say March earlier, I meant June. So what people are kind of afraid of is that we just had a recent unemployment. Was it 4.2? Yeah, I think it was 4.2.
Yeah, 4.3.
4.3. Okay. So what people are kind of projecting is that, hold on a second, this SEP is going to be updated, and like people are expecting, I don't think, like, we already know we're going to get a rate cut. The thing is, we don't know if we're going to get 2 rate cuts or 1 rate cut, but all that set aside, it's not going to matter whether we get 1 or 2 rate cuts. Like, it doesn't even freaking matter. That's not going to make a difference. What's going to make a difference, I think, is this SEP and what they're going to be doing. Are they going to completely end quantitative tightening, or are they going to continue doing quantitative tightening, which means that they're going to basically running off their balance sheet, which is good. You know, it's good in terms of the Fed, and it's basically preparing them for the eventual quantitative easing that they might do in case something bad happens. But what we're seeing here is that the terminal rate for, let's see here, am I showing it here? Okay, so the federal funds rate that they're projecting for the median is 2.8% long term. By 2026 is 3.1. Again, this is from June. So if this comes in, originally in June, they only projected to do less than 2 rate cuts by the end of the year. So obviously the market is pricing in at least 3, so 3 to 5 rate cuts. And what the market is expecting probably is for this to say like 4.75 for 2024. And then it's probably going to be like 3.5. And then it's going to be like probably less than 2, 2.75 or something, whatever this longer run is where they want to end up. So the thing is that if these numbers come in a lot lower over here, and unemployment is higher, all right, I think CPI is tomorrow, and then PPI is Thursday. I don't think these numbers really matter anymore. The Fed Jerome basically came in for what's that called? Jackson Hole. He said like inflation's done. So I don't think it really matters. This is going to be pretty important where they see unemployment rate and where they see the Fed funds rate as far as the end of the year next year. And I think what the market is doing is that they're front running what they think is going to happen. And ultimately, the Fed usually takes whatever the market gives it because they don't want to spook the markets. So what we're currently heading toward on the, let me go to the CME Fed tool. And then, okay, cool. I'm still sharing the screen. What we're currently heading toward is we got a 35. This thing keeps changing, man. I think this actually changed during the debate. So maybe, yeah, the market's dropping. Maybe Harris winning is actually bad for the market because the more rate cuts we get priced in, the worse it is for the market. Anyways, we got 35% chance of getting 2 rate cuts, and then 65 getting 1 rate cut. And then if I go here to December 18th, this is basically what is going to happen for the December meeting. So this is through the end of the year. So we have a 42.1% chance we're going to get 6 rate cuts by the end of the year. So that's 5 rate cuts by the end of the year, 42.5% chance. So if that's the case, then this number that I have here, or that they have here for 5.1, this is going to change. All right. Like this is going to go down like a whole percent. If that happens, like, I don't know. I honestly don't know if that's going to be bullish for the market, because that's a lot of rate cuts to be pricing in by the end of the year. If that comes in low, then that means that this unemployment rate, this might be 4.5. We already got the last unemployment rate for August, and that's the last one we're going to get for the September meeting. So really, all the cards are out. I mean, all of the numbers are out there, and the Fed is just going to show their hand. But I think we're going to know pretty soon what that hand is, even before the meeting happens next Wednesday. So we'll see, man. We'll see. Do you think we're going lower before then? Do you think we're going higher?
What, like
the market?
The market's just unsure what's going to happen. I mean,
yeah, there's a lot of uncertainty.
The markets love certainty, that they hate uncertainty. So my thing is, my thing is once the rate cutting cycle starts, there's definitely going to be some cobwebs that are going to have to be knocked off a lot of business models. But I think overall we'll be okay for at least the first half of the year. I mean, not first half of the year. Sorry, the end
Last
of
half of the year.
Yeah, the last half of the year we could get a Santa Claus rally. The biggest thing to keep in mind is we don't know 100% if there's going to be a recession or not. So instead, it's better to just play call. Yeah, well, we'll see what happens. To me, it's just I'm just being a little bit cautious and just finding value that's out there that requires me to take on a lot less risk in the short to medium term. So number one, I wouldn't do any short-term options. I wouldn't necessarily buy into like a lot of growth names. The valuations have to be reset a little bit more on the growth side in order for me to get really interesting, though there are some in the mega cap space that are getting really, really interesting, like Google. Of course. Google. Yeah. Things like that. It's just I'm keeping my eye on the prize right now with regards to the beneficiaries of interest rate cuts. And I think that's what I'm going to be positioning myself for 2025, which is I'm not going to be looking at growth. I'm going to be looking more for value. I think value is where you want to be in 2025. And so there's a lot of great companies that are trading at single digit PEs that are going to benefit significantly from either counterparties that are going to have more money to spend because lower capital requirements and more access to capital. Because we just said right now the banking system is going to be given a little bit more free reign. Real estate, especially on the commercial real estate, might be interesting as well. But you're going to have to be very careful with the types of companies that you look at. Like not every real estate equity company like REIT is created the same. So you have to be very, very you have to do a lot of due diligence to figure out like, okay, this one you want to buy into and this one you want to avoid. Because eventually people will leasing rates are recovering. Office property values are going to recover, especially once rates come down, because that means that people are number one, businesses are all forcing their employees to come back to work and just saying, no, we want you physically out on the site now. And every day that goes on, that is happening. Last year, there was a little bit of a pushback that the employees could have given because it's like, oh, look, you're hard up for employees. So we got you by the balls. Now the entire equation's kind of flipped with unemployment rising. So now if an employee says, no, I'm not going to come to work, I want to work remote, they'll just say, okay, don't come from now on, you're fired, And so the businesses now have the upper hand in getting employees back to work. Yeah, everyone pretty much.
Amazon. Amazon's been a big proponent of that. They sent that letter out. I think it was late last year. It's like, if you don't come back to work and clock in your key card, then you're done.
No, I mean, dude, if you just look at the news,
it's happening. It's happening.
It's happening to the umpteenth degree. And the thing is, all of this, right here, you just have to search for it. PwC is a huge, huge company. They're just saying, look, come back to work or you're fired. There's no more COVID. There's no more arrangements that we have. And this is across multiple industries that this is happening. So I expect offices to be buzzing again, real estate to commercial real estate to come back a little bit. And now with credit becoming a little bit more accessible, you're going to see a lot of the business models recover. So when it comes to REITs, there's actually some preferred equity and some REITs that I really like, and you know which ones I like. And I'm going to be going pretty heavy in the next couple of because I had no idea. So me, I did something dumb, and maybe it's because I said so.
I do something dumb every day, dude.
I got a whole bunch of money for selling my condo in New York, right? And I went to the bank with my wife, and I was just joking with her, right? She was doing the deposit, and it was it was like a 6-figure amount they were depositing, but it's a bank check, it shouldn't be an issue. So so my wife is like, shh, stop talking so much. I said, babe, it's not like we're depositing drug money over here, right? And so the bank teller looked at me all weird and shit. So basically the guy put a 10-day hold on my money. So now I'm like, man, I want to take that money. I want to buy this shit so badly, but I can't until the bank clears. I mean, it's probably the dollar amount because it was such a big figure that the bank has to mandatorily put a 10-day hold on it. But
there's got to be something like that.
Yeah, but it's funny. So now I have to wait until next week. But once that money clears, bro, I'm a net buyer in a lot of great stuff. And basically, it's like a nice little side income. You know, not that I don't have enough side income coming in, but it's just this is the kind of like stuff I love in the market. You find these real value opportunities, you buy it, and then you relax for the next 10 years, and you don't have to worry about it.
There's quite a good amount of opportunity. Like if we're talking about a 10-year timeline, there's actually a lot of good opportunity. Now, speaking of good opportunity, I wanted to touch a little bit on your thoughts of NVIDIA. Going back though, what did you think about the Oracle earnings call?
That's exactly why I think NVIDIA's got like a year and a half, maybe 2 years of additional.
Really? Because of one earnings call? Like what about that changed your mind? Because I feel like that's the same thesis that we've been hearing for every single hyperscaler.
Do you know how big Oracle is? I mean,
do you know how big AWS is?
I know AWS. I know all the hyperscalers are big, but trust me,
they're going for 2.4 billion to double that amount. How is that equal to 100 billion?
So a couple of things. Oracle is building data centers like there is no tomorrow. But if you look at all these legacy systems, everyone still runs Oracle shit. Okay. Especially governments like around the world. Oracle is freaking everywhere.
They're all commercial clients.
So one of the things is like, I get that the hyperscalers are doing a lot of investing in the AI, but when you have the likes of Oracle putting their like, I really thought Oracle was going to be a lot more like, yeah, you know, AI is a thing and we'll sell our services. But dude, Oracle just came out and said, we're trying to build nuclear power plants because there's not enough energy like required to get all this stuff.
They're building a data center for a company that owns 3 nuclear power plants, and they're basically going to build like a gigawatt data center. No, it's pretty crazy how fast they're scaling out. But that's not going to be done for at least like 3 or 4 years. In fact, I don't think I like Oracle, really good company, and you know they got really good prospects and stuff. But I think when it comes to Oracle is a great company. Like they can automate these data centers and build it out, but their niche is government. So if government does really well, Oracle will do very well. The thing is that I just feel like the market is really getting ahead of itself when it comes to Oracle, given that what they did project a pretty good guidance as far as how much money they're going to make in a year, but you know they made like what was it 13 billion? Did I forget about what that one was? Let's actually bring up the numbers. Let's bring up the numbers from the Oracle earnings. I'll bring it up. We'll use this tab.
No, it's good here. I was going to use this one
because I'll go for it. Yeah, that's way better. That's way better than what I have.
Yeah. So you can see here, cloud and cloud services. They basically did about 10
can you
billion.
Close
this is for the quarter.
Can you close the right sidebar there? No, not that one. They're not there. There's like a little arrow. There you go. Thank you.
Okay.
Yeah.
Right here.
13 billion.
Right. Operating margins around 42, almost 43%. Earnings is about $1.39. They're taking all of their free cash flow, buying, like just building out more and more infrastructure. Okay. So this super bullish for NVIDIA going forward. I really thought we were at the tail end of the growth cycle, but dude, all these new players are coming in and all of them they're just like, we're buying more GPUs. We're buying more GPUs. So,
but it's just, why is it with Oracle? Like I feel their capex is only 2.4 billion TTM, right? And then they're projecting for double that amount. So okay, fine. As far as like a growth goes, as far as capex goes, they're increased by 100%. That's not nearly as much as Google, Amazon, Meta is doing.
But they
aggregating.
But they're so low on the totem pole that they literally are going to be doing this. And if they're doing it, all the other little guys are probably going to be doing the same exact thing. So my thing is, I'm with Steven Fiorello a little bit. I fucking just said it. Damn it. I shouldn't have said it. He's going to call me up tomorrow and be like, see, I was right. But basically, it's very likely that we squeeze out at least another 2 years worth of 30 to 40% growth on NVIDIA's part. And then when you combine all the cash flow that they're generating, and then they're buying back its shares, especially as these moments where the stock goes down, it's just value accretive going forward. And I'm sure that NVIDIA is cooking up some other freaking software related products that are going to generate even higher margin revenue going forward. It's more of a 3 to 4 year cycle than I had originally thought. I thought it was going to be another at least year, in which case now any slowdown in growth would eliminate, will basically send the stock down. We're not going to see less than 30-40% growth at least for another 3 years.
Okay, it's the cyclicality of the business revolves around its GeForce or GPU for consumers. That is where cyclicality comes from when it comes to NVIDIA. If you take a look at the revenue of their gaming business, that is where it's very cyclical because it's based on how good the consumer is doing. And that's like literally in waves. But when you're talking about accelerated computing, buying and releasing and selling hardware for data centers and companies like large corporations, like they have to invest hard. They have to do really good. What was it? Mark Zuckerberg, he always said, like, we fell behind in this investment strategy, so we don't want to fall behind again. So we have to continue investing. Even Matt Garman, I forget his last name, the new AWS CEO, he's like, we have to invest in the future, and then we're just not going to stop. Like, if one of these companies takes a breath to slow down and just like, just chill for a little bit, like, guess what? Meta's going to be ahead of them, or Google's going to be ahead, or even Oracle. Oracle's catching up. When you see that competition catching up, like, you just got to go full on and you just got to buy. And plus these companies are just printing money. So it's like, what else are they going to do? Buy shares? I think they're going to get a much better return on capital if they do invest in this CapEx. And again, it is not just GPUs. This is accelerated computing. This is building infrastructure for the future, not just tomorrow, not just because somebody wants to train a model. This is for the future. And like what Larry Ellison was saying, he was saying that he basically debunked the whole theory that, okay, we're going to be training the large language models now, and then it's all going to be inferencing later. But what he kind of made a little bit of a metaphor was that when you go to college and you study for your degree and you leave college and you start working, you don't just end the learning there. Like, there's like certification stuff you have to get. Maybe some people, they get their master's. Maybe you take like a course or something to learn like a new skill, whatever it is. Like, you continue learning, you continue training. And that's going to be the same thing for these language models. Okay, because they're never going to stop training. I personally don't think that it's going to end in 3 or 4 years. I think it's going to last way longer than that. But at the same time, NVIDIA's run, how long is that going to last for? Maybe I think it might be 3 or 4 years. I do think we're at the early stages of it, but at the same time, the game is going to shift and there will be another leader in the market, and it might not be hardware anymore. It might be more software. And I do think Oracle is kind of rounding out about that, because they are a software company. They're not necessarily a hardware company, but they are seeing massive growth in their hardware sector. And, it's the same thing for Broadcom. Broadcom acquired VMware, and now it is inorganic growth that they do have, but they're learning how to optimize that growth to have it continue and then become organic to their other businesses. So I don't think this is going to be 3 or 4 years, dude. I don't think it's going to be 3 or 4. I think it's going to be longer than that.
Well, for me, I wouldn't say I'm like ultra bullish on NVIDIA. Like, oh my God, NVIDIA, this is just, we're going to get another 1000x. Like, no, like a lot of the growth has already been.
I think most of it happened.
Yeah. So the thing is, like, now you get this nice long tail of, like increases going forward for at least a while, until something slows down. But like I said, right now, there is no news that is coming that says that any of these hyperscalers are cutting back on spend, so which means that NVIDIA, it has a better shot of getting to 150 than getting back down to the 50s. Not that it couldn't get back down to the 50s. Don't get me wrong. Like, you have a couple of bad earnings, like you have a delay in Blackwell again, and you have all this stuff. The market sentiment could shift to the downside, so don't think that that's not a possibility. But I think it's a better chance. Yeah, better chance that this gets to $150, which means it's almost a 50% upside, not 50, like 40% upside from here in the in probably the 1 to 2 year time frame. And if you look at the options market are also really, really good.
No, man, the premiums are so high. You'd have to buy like in the money leaps in order to see a lot of return.
Yeah, but you could always do a spread. That's the point, right? If you pick the right future forward target, you can actually make money on both the theta decay and the capital appreciation on the option that you have, where now the intrinsic value is going to be, the time value is going to be replaced by intrinsic value, whereas the short call that you do, the majority of that time value is gonna be decaying, and then the intrinsic value over time will also decay. So I would say the spreads are the better place to look for NVIDIA rather than the stock itself.
That is your forte, the spreads.
Yeah.
So there's many strategies. I don't think we should talk specifics on what kind of strategy we would exercise on this. We could probably say that for like a Patreon thing, but yeah, I mean, it sounds like you joined not the dark side, the light side, because you've been in the dark side for some time. So, I mean, welcome aboard. We'll be sending you your welcome package soon via mail. It'll probably be in a blue box. And, we hope to see you a lot around later. But it does sound like you are no longer bearish NVIDIA. And it's a good thing you didn't buy those NVIDIA puts when you said you're
freaking opportunistic. I'm opportunistic. Yeah. That's what it is. I also didn't buy puts on SMCI, which I goddamn regret, because
that was probably the best damn short. And I'm actually starting to think that Dell is probably not a good short. But
not anymore.
So not anymore. You would have had to catch the top, like the 150, in order to be able to capitalize off of that. I mean, now it's like, I think you would be giving away money if you started shorting Dell now, because that actually does have a place in this whole cycle when you really think about it. Like, they're a dominant leader. So yeah,
same thing with SMCI.
SMCI does, but I mean, they do. But I think the whole thing with their balance sheets and accounting and stuff, like, maybe it might not be true, but I think like that. I don't think it's going back to $1,000. Like, that'd be great. Well, actually, it'd be $100. It's going to have they're going to have what is this? Dell's thing. Is that true? Is this true?
I don't know. I haven't seen
I don't know about that. That's why I bullish for Dell, to be completely honest. But yeah, that's good. That's good. All right. So I guess we could move on to the next topic. This is actually a pretty interesting one. Real estate nightmares. So we had a Patreon member share something, and this is actually from Reddit, so I don't need to ask him permission to share it. But how do I actually throw this on there? I think I have to share the image and then put the media on there. Hold on. Give me a minute.
Basically, I'll just summarize it. The condo market in Florida is taking an absolute shit right now. And the value.
Hold on. Here we go.
Yeah.
There we go. You can see it.
No.
Yeah. So
you got to share.
Oh, you can't
add to the stage. There you go.
Oh, my bad. Okay. There you go. Thank you. Yeah, so but this is basically say, all right, I'll just read it. Foundation of condos crumbling, talk of over 200,000 per unit special assessments. I made the nightmare decision of buying at a tower 155 in Boca. For those of you who don't know how to Google Tower 155 Boca lawsuit. Basically, they used a bunch of third-rate contractors they literally found on Angie's List, and the building became the Fire Festival construction. Literally, leaks and molds are seeping into the walls in this $1 billion plus building. This 200,000 just gets us the legal cost for the lawyers to sue the developers. Could be 500 mil in repairs. Overall, this place is so damaged it needs new. It needs new, basically everything, including key structural elements that are very difficult to replace. I'm into this place for 2 mil, but the market's about to get flooded. 30% of the units are empty, and a single investor is about to drop 17 more in the market. How bad of a haircut are we talking, gents? Any chance to make it out of this unscathed? So, what are your thoughts on something like this? Have you ever been in a scenario like this before, or known someone who's been in a scenario like that, where they basically bought property that was like that a lot of corners were cut, and it was just like so bad that like they were just underwater and whatever they had?
Yes and no. If you look at how the condo associations are structured, basically you're paying a little bit of money every month. You buy the property because you own the property itself, but then you have like general costs to maintain the general property. Now the thing is, you have to use that to basically build a reserve. The reserve that you build goes towards future maintenance, because nothing lasts forever, right? You've got roofs that need to be replaced. You've got pipes that need to be replaced. You've got windows that need to be replaced. A lot of exterior stuff that needs to be replaced. So a lot of buildings in Florida after the collapse of that one building, basically they had some new laws put in place to basically make sure that they were maintaining things a lot more. But more importantly, there was a requirement that a structural engineer had to evaluate the building for soundness, and based on the recommendations would have to like make the repairs. Now the thing is, a lot of these buildings, they kept their maintenance relatively low for the longest time, and they didn't build a proper reserve. And because the building doesn't have a proper reserve, a lot of the things that they're finding, the structural problems that they're finding, they're expensive. They're really expensive. So a lot of these condo owners are getting hit with what's called an assessment. Basically, an assessment is something where you as a owner, and if like let's say the building needs $100,000 for a general maintenance thing, and they don't have it, what they can do is go to all their condo owners, and based on their percentage, say that you have to pay X amount of money up front in order for this giant project to be completed. Normally speaking, you would want to have like literally you pay more upfront for the the maintenance, so that this way there's more money in the general pool, so you don't have to do a lot of assessments. Like my condo in New York, I just got hit with a $5,000 assessment this year, and right before I sold it. Like, it's freaking crazy. Like, but this is the kind of stuff that happens. Like, basically, we had like some issues with the boiler, and the boiler needed to be replaced, and all this other stuff. So it kind of just it becomes one of those things that you have to deal with. So a lot of the costs that are usually borne by you as the homeowner are borne by the general building itself. But the thing is, like, if you get hit with like a giant repair, especially what this guy is talking about, that could be in the hundreds of millions of dollars worth of structural repairs, you're looking at the equity worth in your property be next to zero.
It's gone.
So a lot of these people, like these retirees in Florida, especially, they bought like, let's say, a condo for like $200,000, like, back in, forever ago. And their maintenance was like $300-$400 a month. And it's like, yeah, they could afford that. The problem is an assessment comes up, and the assessment is like $50,000 per condo unit. And these retirees are like, bro, I live on a fixed income. I don't have no $50,000. So they're forced to sell. The problem is, if everyone is forced to sell at the same time, then you've got yourself a giant pool of homes that are going to be on the market coming at the same time. And the thing is, a lot of people are like, wait a second, this building needs a lot of repairs, so I'm not going to buy into it at full price. Like, would you buy a condo knowing that it needed all these structural repairs and everything, where right now you're getting hit with a $50,000 assessment, but in the future it could be another $50,000? So a lot of people are shying away from the condo market in general. And if you look at this, hold on one second.
There's going to be like someone who's going to buy everyone out, and they're just going to destroy the building, rebuild one, and make a lot of money from that one, probably.
I don't know about that, but basically you can see here, like, the inventory in Florida, it is just spiked like there is no tomorrow. So a lot of the costs of home ownership, like, a lot of people thought like, oh, I'll just buy my condo in Florida and I'll be able to retire nicely. Nope, that's actually not happening right now. And if you look at like the median sales price, Florida median sales price, let's say median number of days on the market. Look at this. It went from 36 to now almost 74 days, which is a huge jump. So it's not unusually based on historical amounts, but it's still a significant amount. If you look at the median sales price, Florida.
I don't know, man. Property in Florida, especially like near the coast and stuff, the erosion from all of the weather,
salt water,
that's one thing, is like, whenever I buy a house, or if I were to think about buying a house, like, unless it was like, some sort of rental property or something, like, I would never live by the water. Like, you are putting, you have to get, your insurance is a lot more expensive. And I'm sure Matt knows a lot about this. He has a lot of rentals and stuff, but like, he probably knows like the maintenance cost of that stuff is pretty high, especially if you're in like South Florida. Like, how many freaking hurricanes like destroy properties around there, and the amount of hurricane insurance you have to have, that's insane. That must be insane.
So what's more important for us to look at is the median listing price. It peaked in June of 22, and since then it's been going down. I mean, and it's nowhere near its historical levels, especially when you compare it against like affordability. So if you look at and the Atlanta Fed does a great job of this. Atlanta.
Can you drill down by city in Florida?
Yeah,
or like
yeah, I'm about to.
Yeah, because I'm interested in Miami. I want to see what that looks like.
1 second. Okay, so let's see. Metro Miami-Dade. Okay,
What?
So no, so which county? Miami, Broward, right here.
I don't know which county it would be, to be clear.
Miami is Broward County. So right here, you can see here the current median income in Broward County is about 77,000. Median home price is about 487,000. So it's pretty much up there in terms of like unaffordability. Let me just see the
that median income is pretty low considering those home prices. So basically, no one is buying a home for the most part.
Yeah, and the thing is, like,
not many people can afford.
Let's see, Broward County. No, Miami, Fort Lauderdale. Okay, so there you go. This is like super, like before it wasn't like, oh my God, affordable, but it was at least decently affordable. So in June of 2022, the median home price was about $283,000.
That's insane.
With an interest rate of like 3.2% at the time. Now it's 487,000.
That's fucking insane. How do you go from almost 100? Wow, that's
because a lot of people, they bought into the market, man. Like Miami is where you want to live, you know. So a lot of people moved to the state post COVID, and a lot of people stayed. So So now the problem is you've got inventory in probably that area in Miami.
Please don't happen to LA. I really hope that doesn't happen to LA. I'd be screwed. I'd end the pod. I'd be like, I'm done. I can't afford this anymore.
Right here. So even active inventory in Miami hasn't recovered though. See, to like pre-COVID levels, about 23,000 was, I think, the peak of active listings. Right now it's sitting at about 14, but you can see it's on the way up, which is never a good sign. You know, more inventory equals what is that thing called? Equals lower prices eventually. And you can see here from the green side how many listings there are per count at the county level. My thing is, with interest rates coming down, I think we're more likely to see a lot of inventory come to market. So a lot of people are holding off their inventory, like they want to sell.
Demand's going to go up,
but demand will go up. There's still, I think, a lot more inventory is going to be coming on the market overall.
I don't think it's going to be that bad, to be honest, because you're going to have a lot of inventory come up, but then you're also going to have people be like, well, I could sell my home now, so now I could buy a new home. There are going to be people moving around and stuff. I don't think,
which is why we have to be long with the home, not necessarily buying a home, but being long on the transactions market. So the companies that basically buy and sell mortgages, the companies that issue mortgages, you know, even real estate like listing firms, they're going to do well because they'll, you know, more listings equals more money, you know. So
yeah, man. All right, so want to talk a little bit about cybersecurity. I've been asked about it more than a few times. So recently, actually yesterday, Rubrik, cybersecurity company, and I've talked about it several times on the pod. I actually had a long episode. There was an episode where I talked about it for like 20 minutes. Rubrik had its earnings, and just to remind everyone, Rubrik is a company that is not directly competitive with like a CrowdStrike or SentinelOne, which is endpoint security, or SSE, Security Edge, or SACE, like Palo Alto, Zscaler, or Fortinet. It's something that's more in the data and backup realm. But what they are getting a little bit into is threat hunting per se. That's one of the newer products where they would really scan every single one of your backups to see if there's any to see if there's any malware or if there's any security issues in them. So that way, if you were to recover to something, they would already have a backup ready for you. In addition, they are doing a lot of scanning for private information or for sensitive information. So then that way, if you do need to recover, or if there is like private information in certain parts of your code that shouldn't be there, then it can help you try to hide that information. And I guess the long-term view of this is that this might actually help when you're thinking about running a retrieval augmented queries, or basically using like an LLM or something, or running queries on it, to make sure that you're not that there's nothing that's being shared out there that could be private information or that could put your data at risk. So it really is all about data risk, and that's the thing when it comes to a lot of these ransomware attacks, is that they take some of your data and they basically hold it hostage, and they say they encrypt the data, and they say that, hey, if you don't pay us like $1 million in Bitcoin, we're going to release this sensitive information to the public. And some companies like United Healthcare, they have to pay them out because they can't have that data on there, because it'll obstruct a lot of the contracts they have, especially with the HIPAA laws and everything. So let's I wanted to bring up the slide, or I wanted to bring up their recent earnings on here. Actually, no, you know what? You kind of gave me a little bit of an idea here. Consensus Guru always does a lot of those charts. Makes it easier to look at. So I'll just search. Can you help me to try to find it in the background, so then that way, if I can't find it, you already up? No, that's not it. I should have probably brought this up. I was just going to bring up the slide. Anyways, I'll just bring up the slide in the meantime. So Rubrik IR. Let me go down here to events. All right. And quarterly results. And they got a nice, beautiful presentation here. So this was actually, I mean, I thought the earnings were pretty good. The market did not like more, probably a couple things here, but what they didn't like is the margin, what happened to its margins, where they had a triple beat, right? So they beat on the revenue, they beat on the income, which is still negative, and they do measure it on a non-GAAP basis. And they did increase guidance, but the market didn't like the fact that I guess that they were expecting all the margins to continue expanding, but they did guide for a little bit of margin contraction. If I go down here to, let's see here. Here we go. So the subscription ARR contribute. Actually, no, that's good. Where, you know what? To be honest, I thought I saw it somewhere on here, but I guess it's not on here. Anyways, what I could do in the meantime is to kind of visit some good numbers in here. What they are projecting for fiscal year 2025 is that they're going to actually surpass $1 billion in subscription ARR. And keep in mind that subscription ARR is only a portion of their revenue. They do have other revenue like perpetual licensing and stuff for even their legacy products. But the fact that they're already coming up over 1 billion ARR, and currently it actually dropped this morning, and then it recovered throughout the day, which is pretty interesting price action, because today was actually the day where the lockout period, since the IPO'd in late May, was actually ending. So that means that people who were in the IPO could actually sell all the shares today. I did expect it to dip a little bit lower than it did today, but it actually didn't. So its market cap right now is 5.77 billion, and their subscription ARR is guided for over 1 billion. And this is just their subscription ARR. Okay. So total revenue, the subscription ARR is basically, it's telling you the annual recurring revenue for all the subscriptions for the company. And that's a bit different from the total revenue. The total revenue is just how much that they realize through billing and how basically how much they already bill the client. The AAR isn't necessarily that figure. It's basically taking whatever whatever the clients are expected to build for the entire year, and it's just showing you what that revenue would actually be for this particular line right here. So if we look at the subscription ARR that they're going to be getting 1 billion, and then we look at their market cap 5.77, that means they're trading at less than 6 times the subscription ARR, and they actually did grow more than 30% last quarter. I've been sharing the wrong screen the whole time, haven't I? This is the tab that I actually wanted to share with the guidance on it. So last quarter, they grew at the subscription ARR grew at 40% year over year, and the revenue grew at 35%. So assuming that this actually continues, then next year, the following after that, that 1 billion, if it continues growing at, let's be conservative, it's like about 30%. So that's going to be 1.3 billion. And that means that at that rate, if it continues trading sideways, let's say it's at 5.77 billion, and like let's say they dilute a little bit, let's just bring that all the way up to about 6 billion. That means that they'd be trading a lot cheaper than they are on a fiscal year 2026 basis per se, than they're trading at today. I'm not going to go out there and I'm going to be like, hey, this is like a really good stock to buy. Like at the same time, this is very risky. They are still a cash burning company. I did read somewhere, I didn't see it actually in the earnings call transcript, but I did hear someone say that, and they had like a quote on there that the CFO said that they would be free cash flow positive by next fiscal year. So that is good news, because right now they still are burning cash. And they have negative free cash flow. But if they do get to the point where they are no longer free cash flow negative, that might be good news, because that means that they're less likely to dilute. And as a business, they should be able to sustain themselves where they don't need to go out look for additional debt. Again, I would say this is still a small cap since it's less than 10 billion. But the earnings were really good. And if you want to be in cybersecurity, I think this is actually a pretty good company to be in, considering that it is backed by Microsoft. They have lots of partnerships with multiple cloud companies and hyperscalers. And again, with something like this, when I say again, because I did mention this last time, is that their platform, Rubrik security platform, RSP, it's basically it's cloud independent to one of the public clouds. So like you could be in Amazon, you could be in Azure, whatever it is, you will still be able to deliver your data to Rubrik, and you won't be charged for all that egress cost of sending your data outside, because it could still stay within Rubrik. And I do think that there's a very good possibility that this company, unless the market rolls over, that this might not see the prices that I expected that we would see on this company. If I bring up a chart here, actually, no, not that one. I'll do this one and share that screen. Here we go. So this was the price action that I saw today. Okay. This morning, it went all the way down here to 29, and I guess I got a little bit greedy. I was expecting that we'd see newer 52-week lows, but I guess it didn't even try to visit the 28s. So I actually ended up accumulating a little bit more shares in the low 30s. But at the same time, you could see here that generally people say to stay away from IPOs for at least a year, so that way everything can settle. But given that there is a very large and fast-growing TAM for cybersecurity, it's possible that we might not see the lows that I would expect to see in a company like this, especially growing at about 35% year over year, where their TAM, I think, is around $30 to $40 billion. And they do have a bit of competition, but they are winning a lot of contracts. And one thing to kind of understand with a company like this is that even if, let's say, someone has CrowdStrike, they have like the whole CrowdStrike suite, they could still have Rubrik as their backup solution. So it's not something that directly competes with like some of the large cybersecurity companies you've been hearing about. This competes with more something like Commvault or Cohesity, which are backup solutions. And I think that the TAM is becoming a bit more significant. What Bidhal Supal was talking about on the earnings call was that they are landing a lot of contracts. Their clients over $1 million ARR is growing pretty rapidly, and it's continuing to grow there, and they're continuing to gain market share in the company. Again, take that with a grain of salt though, because he is trying to promote his own product, but I think that there's a lot of good prospects for this company. If anybody has any questions, feel free to ask. So sure. Oh yeah, thank you, Rage Rocket. I didn't realize I was doing that till later on. But yeah, I mean, as far as that goes, I would say the whole cybersecurity sector is probably one of the best places to be in when you're thinking about getting good return on capital for long term, like 4 or 5 years out. Definitely think that CrowdStrike, and I've heard this many times on the other earnings calls for like SentinelOne, for Palo Alto and even Zscaler, is that no one's actually saying that they're gaining a lot of share from CrowdStrike customers who've left. And they said, I don't want to be a CrowdStrike, but like it is in conversation that they want to platformatize from CrowdStrike. But so far, it might be too early to tell. But even with the guidance, it doesn't seem like there is that massive as an impact from CrowdStrike as I expected it to be. So I did go long CrowdStrike again to my max position size. And this was coming after I sold 85% of my position in the high 300s, mostly due to valuation. And I guess that was just pure luck. Gail asked a question. What do you think the impact will be for the lawsuits CrowdStrike? Well, I mean, yeah, I pretty much summed it up already. Maybe you typed it in before I said anything. But yeah, I mean, I think the worst that we expect to see has already come. And I think the market does realize that, which is the reason why you might not see CrowdStrike below $200 again. But if the market rolls over, then, all bets are really off. Anything can happen. But yeah, man, how's that Palo Alto doing for you? You're on mute.
It's doing okay, man. I'm not even... There's so many things that they're just a secular tailwind industry. So you don't have to really look at them all that much. They're not tradable positions. They're just buy it, hold it, and just relax.
Yeah. Palo Alto, June was saying that she likes CrowdStrike, Palo Alto. So, I mean, if you want to think of a company as far as maturity goes, Palo Alto's been around for way longer. They've been GAAP profitable for some time. They're more mature, so they do have a lot more stickier customers. But one thing you got to remember, though, is that Palo Alto's flagship product is not the same as CrowdStrike's, where CrowdStrike is more endpoint security and Palo Alto is more of enterprise security. They did come from specializing in firewall as a service, but they have innovated strong ahead of time to kind of see where it's all going. And to be honest, they do have a product that hasn't been out for a long time where it is endpoint security, but it's like kind of their goal where they want like people to sign up for like just one cybersecurity company and just get all the benefits of that one company. So, but if you do think of like how good of a product is in terms of endpoint security, it really is just like CrowdStrike is just the dominant leader, and there's Microsoft as well, and then behind that would come something like SentinelOne. But there's gonna be enough food for everyone to eat. The TAM is just growing pretty big. I would say that no matter who is in this industry, unless like their go-to-market team or management team is just terrible, I think any company really do really well in this sector. Yep. So, with that being said, we can just talk a little bit about the iPhone that came out, the iPhone 16.
Bro, that wasn't an iPhone. That was the iCamera. Okay, the iCamera, like literally the entire presentation.
That was a damn good camera, though. I'm not gonna lie. That was pretty innovative.
The camera can do that. The camera can do this.
I mean, I don't think that warrants like spending $1,200 to upgrade to a new phone, but having that camera button is pretty convenient because countless times I found it very annoying.
Greatest innovation of the decade, a camera button.
I mean, I don't know, man. That's like the AI shit right there, but
There's no pretty let down. Apps. I
was pretty let down with that. I was pretty let down with the Apple intelligence that they've been like preaching and stuff. Like we all thought that it was going to be like a full-on conversation to have with Siri, and that just was not what happened. Like it was like, yeah, they could like correct you or something, but like that's really it. There was nothing special about it. But
there's no webhooks into the other applications that you have. There's no other
none of that.
It's
none
just
of that. And none of it
feel like
most of it doesn't come out until later in the year, even next year. So
yeah,
I don't know. There is that.
I was
but,
thinking that we could like replace our wives or something with this thing, you know, just be like, "Hi, honey, good morning."
Well,
You
the
know,
Indian
like you have an
isn't
8:30
out yet,
meeting
so
today. Huh?
even if that did come out, the Indian language speaking Siri wouldn't come out yet. So give it
Wow,
a while.
wow. Like, hello, honey, welcome. Let me get you a cup of chai.
Siri would be like, "Can you
Yeah.
please like not talk with that big accent? Because I have no idea what you're saying."
Yeah.
Oh
No,
man, yeah,
it just
dude.
didn't feel that innovative. I mean, I was gonna
They haven't
replace
been
my phone.
innovative in a while. Yeah.
I
So you're
was
gonna
gonna
replace your
replace my
phone.
phone. I'm not. I'm gonna keep my 10X. I don't need 10XS.
You have a 10X?
Yeah, it works
How much
great.
money did it make in Celsius?
A lot, but I don't need to spend money I don't have to spend money on. Like, what's the issue?
Okay.
What's the issue?
It's
Like,
slow. It's so slow.
what are you talking about? All my
It is
applications
so
run just as
slow.
fast.
I don't know,
Everything
man.
runs great. I love
And you
it.
work in IT too. I'm surprised that you think that it's pretty fast, but like, dude, like even when I
Like,
had the
what do
12,
I
like that
look?
shit was slow.
I do 5 things on my phone. Okay. I go to Discord, I go to Robinhood, I go to my Fidelity app, I text back and forth, and I FaceTime my wife. And that's about it. And sometimes I'll call my mom and I'll talk to you on WhatsApp. You know, that's about it. Like, I don't have a lot of functionality that I need. Like, if I need to, let's say I'm flying somewhere, I'll put on an audiobook. It's, you know, I just download the audiobook. Like, every
Yeah, but you
application
have a
I have
10X.
works. I just don't see the additional need for it, man.
We can't
You
be
know?
friends anymore. 10X? I don't know if I could do
Like,
this anymore.
you know,
As long as you don't have an Android.
I don't have an Android, but that's the point that
Yeah.
I just don't understand why everyone needs to upgrade their phone every single year, unless like, I mean, the only thing I would say that is a little bit annoying is that the battery life is a little bit, you know, like not as good as it was when I first got it. But even that, like I work from home, so I always have a charger near me anyway. It's
Yeah,
got
that's
wireless
true.
charging. It's got wireless charging, which is
Yeah.
fine.
Don't you think it's like pretty suspicious that every time there's like a new iOS that's out, your phone just gets that significantly slower? Like I get that, you know, there's a new OS, but it's like it is literally like as soon as the new one comes out and you don't even upgrade your OS. Like let's say you update like a patch or something, like it still gets significantly slower. It's just like there's like a whole conspiracy theory behind that where that's basically like Apple's way of just trying to push people to like get the newer phone or whatever.
I don't know,
But yeah, man, we'll see. We'll see. I would say that like if someone really wants to get a new phone, like for you, you could probably just get like a 14 and be happy. Like I don't think what I saw yesterday warrants like everyone needs to get at least a 15 or a 16 in order to be able to like reap these benefits. I don't think the benefits are that good enough where it's like you have to get a 15 or 16. It's like no, the 14 is cool. You don't need like this AI Siri and whatever. Like it ain't even AI.
Yeah, I might just do that actually. The thing is like maybe I'll just get one of the newer ones and then just hold on to it for another 5 years, you know. I just like I said, I don't see the additional. I like my phone. It's got the perfect size. It's like I have a case for it. I have all the charging accessories I need for it. Like
yeah, once you get that 15, there it goes. You
I
go
don't
to
know
USB-C.
what's the major difference? USB-C, that's it.
So from 14 is the last one where you have lightning cable charging. The 15, once you get into the 15, it's USB-C. And
Okay.
I had to do the switch when I got my 15, but I don't know, man. The USB-C cables are so damn cheap nowadays, it just doesn't even matter.
I like my lightning. I have all my lightning chargers though. So
I know that's the only thing is like unless you and your wife upgrade, you're gonna deal with 2 different cables. Unless like you update the iPads and the AirPods or whatever, like you're dealing with like a whole different ecosystem. Now you got to throw all that shit away. That's it. That's CRWD. It's like my kids got the iPads and they got the lightning cable, and then my AirPods are lightning as well. But then like I got this one freaking phone that's USB-C, and I have like no other option other than charging my desk. But I don't know.
I like USB-C, but it's just I don't know. It just doesn't feel like I really need to upgrade. So I'll probably hold on to it for another couple of months. You know, maybe if there's some like heavily discounting that's available, maybe I'll go for that. We'll see. Yeah.
I still think there's going to be a massive growth in Apple. Well, not massive growth, but a re-acceleration of growth in Apple. And I think people are going to be very surprised when the quarter comes out. next month.
I mean, even if they don't have huge reacceleration and growth, the amount of share buybacks that they do is insane.
Yeah. I'm bullish as hell Apple, dude. I'm bullish as hell Apple.
Yeah, I just, like I said, I wish they just would either create some new products or work on some applications. And you know what? Maybe that's where the real alpha is in VC markets right now, where there could be an application coming through the VC channels that's like absolutely game changing for AI, in which case, like, we have to be on it so we know which one it is.
Yeah,
does anyone in the comment section, do you guys know if there's any AI applications that just recently came out that are just like, oh my God, like, believe it or not, I discovered ChatGPT when it first came out and I was like, oh my God, this thing is amazing. So I'm trying to find the next ChatGPT. Like, what's the killer app that's coming out that like no one's talking about, or new technology that's coming out that no one's talking about?
I have to admit that I use Copilot at work, but I have a specific niche work because I'm a developer. But other than that, I don't really find a huge use case on a consumer level for anything other than just going to like freaking ChatGPT and just asking a stupid question. Like other than that, like I don't really see like a use case where it's going to make my life that much better to have this. But we'll see, man. We'll see. I mean, I think Apple's going to do pretty well as far as the stock goes. I think it was probably a good buying opportunity. Like last week when I was at 160. Now the mofos.
Apple's never been at 160. Apple's never been at 160. No, it hasn't been 160. What's this? Apple is 160.
No, it was one. When I said last week, I'm exaggerating. It was like a few months ago.
Okay. Yeah. I was gonna say, I was like, wait a second. Last week it was like 2 something. No,
dude, I didn't even know JP Morgan down until today, until like after the market closed. Like that shit dropped like 7%. That's crazy. I don't know. I don't really.
JP Morgan.
Yeah, the thing was down like 7% today. Like that was just pretty insane. And like you're saying, it probably had more to do with what you were talking about with lowering
Ally
the.
Bank.
Yeah, well, the Ally Bank, but
it was because the Ally Bank came out, and so a lot of people are worried now that some of the consumer loans that are on the balance sheets of these big banks, they could be negatively impacted with higher delinquency rates. So the question is,
I think it would have dropped more because of what you're talking about when it comes to the 20 to 9% on the amount of capital they have to keep in their balance sheets. And when you think about it, that's not good for JP Morgan as it is for a regional bank, because then that means a regional bank will be super competitive against JP Morgan.
No, take a look at this. Look, this was something that came out today with JP Morgan. Fell more than 5% after the president of the largest bank tempered the outlook for its earnings from interest rate payments as interest rates are expected to ease. So they make so much money on their net interest income, right? Yeah. Because basically they're giving next to nothing and they're lending it out at high margins. Now that interest rates are coming down, they're not going to get as much attractive income. I mean, this is the problem. Believe it or not, this is the problem for a company like, God damn it, you're going to make me go anti-Palantir right now. And I'm going to do it. One of the problems that you're going to run into with Palantir next year is exactly this. Their net interest income, if you see like right here.
I get it. They have like, how much
it's
they have
almost $400 million in net income, right? But so it's it's great, but look at the net interest income that they're generating. They're generating 171 million is coming from net interest income that they have on their because of cash on the balance sheet. So at the same time, look at the amount of shares that they've issued on a dilutive standpoint. Right now, they've basically been issuing a shit ton more shares and just holding on to that capital in form of cash, and then at the same time lending that out via short-term treasuries and making a buttload of money so their earnings looks nice. Like, oh, look, they're GAAP profitable. But if you're looking at this company from an operating cash flow standpoint, it looks great. Like, oh my God, look at operating cash flow. It's doing really well. But at the same time, it's because they're not paying their employees as much in cash. Instead, they're paying them in stock. And the thing is, their share count is going higher and higher. So if you look at their future,
that's every tech company.
But the problem is right now their valuation is gone insane.
The valuation is bonkers. I think we could agree with that. But long term, I don't think that they're gonna get their valuation cut in half. Like if the market stays bullish, they're not getting the valuation cut in half anytime soon. I do think they could go below the 30s again, but I'm not gonna try to predict that.
Yeah, it's a meme stock, dude. I'm not trying. Like I learned my lesson.
It totally
I'm not
is.
fucking around. I'm not messing
It
around with
totally
it.
is, man. They will buy every fucking dip.
Yeah. There's easier opportunities in the market. I'm not buying it. I'm not going to ride the top. This is like, to me, this is like the Tesla moment from 2021. You know what the Tesla moment was?
Could be. Yeah, no, I remember that.
Yeah. Everyone was like, oh my God, Tesla, Tesla, Tesla. And literally, like if you had bought Tesla at the top, you've been underperforming for the last 5 years, you know?
Yeah.
So this is one of the risks you take on when you buy something at a really expensive price. And even though now you need the rest of the market to catch up. So if you bought around this time in 2021, you've basically been pretty much flat for the last 5 years. You know,
okay, any degenerate mofo that bought Tesla that high, like is not still in it. There's just no way they're still in it if that's where they bought it. But if they've been buying through that top, they might still be holding it. But like, there's no one that hit that buy button around $400 and it's like still bag holding that shit. Like, well, that's if you were that degenerate, you don't still have it.
Yeah,
get the fuck out of here.
This is where guys like what is that thing? They're going to be able to sell covered calls and stuff like that. They'll make money. There's easier ways to make money, but like I said, I think with Palantir, their valuation is going to eventually have to catch up, and they're going to have these peaks and valleys, you know. And the thing is, like, no one can tell you exactly when the peak is, but this was a strong recovery for them. Look at that. From $8
the comps are easy, man. The comps are easy until last quarter, and then that's when we'll see what happens with the next quarter because the comps ain't so easy. After
they benefited twofold. Number one, the comps were easy, but then they also launched AIP, which did gain a good amount of traction, especially with SMBs at the lower and the middle income standpoint. So their revenues look like they're a little juiced for this year. I also, when I look at the company itself and I see this like rah, 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 America, rah, 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 we're defenders of the West. All of that stuff is great. I love it. Great messaging, but it's complete bullshit in my opinion. It really
is. They might have a good quarter next quarter. I think they're setting themselves up for another 27% growth.
They might.
But I think that net income growth is probably going to be more important, or EPS growth. Anyways, yeah, man, I'm still staying long Palantir. I ain't selling no cover calls. Get the fuck out.
Enjoy your Palantir gains. Enjoy your Palantir.
I'm not like full port Palantir or anything. Like, I'm not crazy to do that stuff. In fact, my position isn't that big, but it is nice to ride this wave and just see what happens. I don't care if this thing drops. I don't care. Like, it'll just be nice to just like be in it. Like, but I don't think I'm going to sell cover calls. This thing can just go ape shit.
You think so? You think it'll get past the $80 billion mark, go into like 160 billion on $3 billion in revenue?
I didn't think it was gonna come here, but like, you know, when stuff goes ape shit, it can see like $80 billion with this much retail falling, like it can launch. I'm not banking on for launch. I'm not gonna be like, well, I'm gonna sell the top, but like I'm just saying that, you know, to possibly let go of my shares and have that tax burden will be kind of annoying to deal with because this is not in my IRA. This is in my taxable account. So I don't want to screw that shit up. Anyways,
I mean, you could always go deep in the money calls into the future, basically get a whole bunch of premium, use that capital to reinvest, and now just wait for the theta decay to happen. Imagine right now you go out and sell December 22 $30 calls. You know how expensive those things are right now?
If I'm doing
the way it is
right now, I'm not gonna do it right now.
Or $25 the $25 calls.
I want to see the run up because even though the valuation is still pretty up there, you know, it is probably one of the best, not the best performing, but like it is a very well ran business. So it's a little bit justified in terms of where
it's not that well run.
A little bit.
It's not
how
that
can
well
you not say
run.
it's run? How can, like, what do you think? You just got lucky? Like you can't train a go-to market team like this and be able to perform like that. You just can't.
It's dude,
GAAP profitable 27% growth is no joke. We're not talking about cash flow. We're talking about revenue.
In my opinion, they're sacrificing the future for short-term gains. They're going to do what they have to short-term. And at the same time, the insiders have all been unloading like there's no tomorrow. Okay. And then on top of it, you look at just the complete dilution that's happening. And all of this stuff is artificial, dude, when it comes to their earnings. Like most of their earnings is coming from, not most, a lot of their earnings is coming from net interest income. Next year, when net interest income is going to go down, you're going to see that overall earnings are going to go down. And at the same time, usually you would say, oh, well, they could just buy back their shares. Yeah, but the share price has gone up so much that the buyback wouldn't even help. So it's nice to look at. Look, I'm not getting you, but without that interest income on the cash that they had, if they had just paid employees in cash, you wouldn't have as much dilution, but at the same time, you wouldn't have a lot of cash on the balance sheet and you wouldn't have a lot of that net interest income, and which is the likely scenario next year or so. No, like I said, dude, you do whatever you want, but I would, if it was me and I'm holding this stupid thing, I'd probably be like, all right, sell $25 in the money calls, let this thing do its thing. And at the same time, I get a huge premium. I take that premium, dump it into something that's actually undervalued. And now as the stock price, if it goes higher, whatever, they'll get called away from you, but you collected that premium and use that premium to reinvest. Also, at the same time, if the thing comes down, the theta decay ends up decaying away all of that premium that you collected up front. So it's a great way to hedge, but
you should just get like a deep in the money put, because then the IV doesn't matter as much. What do you mean, sell or buy? Buy a $50 put on Palantir for like 2025 and just
that's like the dumbest thing. Why would you do that?
Just wait. Huh?
Why would you do that? You would get
if it drops like $2, then you're good.
Hold on. First of all, everyone here, what Sam just said, never do that. Okay. Do you understand why you never?
You're not just trying to provoke you, right? Like I'm trying.
I know, but do you know why you never? No, but do you know why you don't do that?
Of course not. Of course you're not going to do that.
Tell me why, Yeah. Tell me why you should never sell deep in the money call.
Buy.
Sorry.
Yeah.
Why you shouldn't buy a deep in the money put?
You shouldn't buy deep in the money put because then if it goes up, then you're gonna like lose fucking money. Is that? Well, if it's deep in the money, then IV matters less, and then that means that there's less in extrinsic value.
Right, but then also at the same time, you're giving up all of this capital lock-in for something that could or could not happen. Well, why would you want to do that?
I'm not saying go like 2% position. I'm just saying just do it just for the sake of doing it.
I don't know, man. If anything, you typically want to buy at the money puts. I wouldn't.
Well, but if you buy at the money puts at this level right now, the IV is so pumped up that you're paying a lot for the extrinsic value.
No, but the IV is pointing to the upside. Yes, there is a ton of IV.
No, the whole thing goes up. If the IV goes up, maybe it might be imbalanced more toward the upside, but at the same time, you are paying that premium that if it went down like even like 5%, like you wouldn't get shit. You'd still be flat probably. It's like the people who bought calls on like GME, like when it was going ape shit, like they got screwed even though it went up.
Even the puts are expensive right now. Like you'd be breaking even at 26, which is not that great for a $35. Yeah, it's just
when does it expire?
June of 2026.
Yeah, I mean that's why you got to get the deep in the money. So then that way there's less extrinsic value. But then technically you'd be shorting it. But you wouldn't have the unlimited risk of shorting it. That's the good part. And you wouldn't have to borrow capital against a broker.
Yeah, I'm good, man. I'm just gonna avoid the name. Not really my forte right now.
Let's see. I'm like hoping like one day you like post on Twitter where it's like, I'm back, bitches.
Nah. No. I realize there's just some things that you're good at and some things that you're not. Stick to what you're good at.
I'm terrible at shorting. I've learned that the hard way. I'm terrible at it. So I haven't bought a single put going down. Like I haven't bought a put on anything since like Oracle. I bought a put on like just as a hedge, and that made bank. Thanks God. Thank you to Futbucker for that and paper gains. But besides that, I don't short the market anymore, man. Because my time is terrible, and I feel like it's just I'd rather have cash. Cash is a much better hedge than buying a put. But yeah, let's call this quits. It's pretty good. Yeah, man. It's good talking. Hope
3 o'clock in the morning.
Yep.
Jesus.
Yeah, you're still working, right?
No, not today. I'm off.
What? Oh,
I'm off
shoot.
Today. Yeah.
Why did we even do this thing?
I'm off because I'm off. I'll talk to you later.
All right. Well, everyone remember, please subscribe, subscribe, and turn on the notification bell. Support the channel, and talk to you guys later. See you later, man.
Bye.